Credit Cards 101, a video by Karthik. This is Angela, a 22-year-old student pursuing a college degree. As she prepares for life in the real world, she believes the rational next step is to acquire a credit card. As of now, she only has a debit card, but her parents have credit cards and she sees credit cards being used everywhere. However, she doesn't know how to proceed. Let's get right to it. First things first, Angela wants to know how credit cards even work. Unlike debit cards, which draw money straight from your checking account at a bank, credit cards don't involve you spending your own money. When you swipe your card, you're spending money that you borrowed from a credit card issuer, usually a credit union or bank. Your credit card issuer sets a limit on how much you can spend at once. This limit is called a credit limit. At the end of a billing cycle, or the time during which you can make charges to your card, you're billed based on what you spent. The bill, usually given monthly, will inform you of how much you have to pay. At minimum, you'll have to make the minimum payment, but you want to pay off your balance, the total amount you haven't repaid, in full if possible. More on that later. Angela can get a credit card from a credit card issuer. After submitting some personal information to an issuer, the issuer will review her credit history, aka her history of debt and how she's prepaid it. Then, based on her credit history, the issuer will either approve or deny her application for the card. But remember, Angela is still just 22. Keep in mind that if you're under 18, you likely can't apply for a credit card. Moreover, if you're under 21, you have to show credit card issuers that you are financially self-sufficient so that they have assurance that your income can allow you to repay the balance on your card. However, because Angela is above 21 and has a job outside of school, she's free to apply for a card. But since she's still a student, she likely has no credit history yet, so finding a willing issuer may not be that easy. If she's fine with being reliant on her parents, she can be added as an authorized user to one of her parents' credit cards. But Angela wants to be completely independent now, so becoming an authorized user is out of the question. Her first option is a student credit card. These cards are targeted at college students, so they typically have low credit limits and no annual fees. Since Angela has no credit history, making traditional issuers reluctant to approve her applications, a student credit card would be great. Another option is a secured credit card. These cards require Angela to make a deposit to give issuers security, and after the deposit they work like normal cards. They tend to be easier to acquire than student cards for those with little credit history. But just like with student cards, secured cards will make Angela's credit history grow, allowing her to eventually attain a traditional card. Finally, Angela has her credit card. Now what? She has to abide by two rules. First, she should never spend more than she can pay back. Second, she should never make just the minimum payment for her credit card at the end of each month. Unless it's absolutely impossible, she should aim to pay off her entire balance each billing cycle. The first rule is fairly simple. Since the money she's spending is borrowed, Angela has to be cautious about swiping her card. After all, if she swipes one too many times, she won't be able to repay what she spent, and she'll fall behind on her payments. Next thing she knows, she'll be swamped with late fees for not meeting minimum payments on time, and her credit history will suffer. The second rule requires us to think about something we haven't yet addressed in this video: interest. If Angela just makes the minimum payment every billing cycle, she won't get in any trouble with the credit card issuers. She won't get hit with late fees and she'll still be in good standing with her credit card company. However, her interest charges will keep piling up. Every credit card has an APR, or annual percentage rate. If you don't pay off your entire balance at the end of each month, you'll be charged interest on whatever debt you have left. The rate at which this interest is charged is the APR. As credit cards charge compound interest, the interest you'll pay builds exponentially. But don't think the APR of a typical credit card company is measly. In America, the average APR hovers at around 15%. Let's put that in perspective. Say Angela had a balance of $4,000 with an APR of 18%, and she only makes the minimum payment every month. Assuming that her minimum payment is 3% of the balance, which is fairly representative of the norm for credit cards, it would take Angela upwards of 15 years to pay back her balance. In the process, she would have paid roughly $3,700 in interest alone, not to mention any annual fees that her credit card issuer may charge for the services it provides. With that in mind, Angela will never again make just the minimum payment. She's spends responsibly, and every month that she can, she pays off her entire balance. Remember, as long as she pays off her balance every month, she won't be charged interest whatsoever. Thanks for watching. I know credit cards may seem like an unnecessary hassle, but if you use them properly like Angela, they are a definitive positive for your credit.